Ladies and gentlemen, welcome back to the channel. So here in this video, we're going to get into what is happening, dude. The NASDAQ is up 17% for Q1 2023, and I think this sets us up for massive opportunity. And I want to go over kind of, in my opinion, why I think this is the rip before the dip. Now, this video does have some implications for certain stocks that we like to invest in. You guys know what I mean. But really, a potential drop like the one we could see, you could make a lot of money on a lot of different assets. Now, if you guys want to come trade with me every time I make a trade in real time, then link down below in the description of this video. There is sources and tools that you guys can help use to help kind of guide you in these turbulent markets. But this video is obviously free 99 because I want you guys to be fully prepared and have a full scope of what is going on. Now, here in this video, I'm not going to give you just the bad. I'm going to give you a path forward that could avert this crash, because I think it's very imperative that you don't stay too directionally bearish or bullish. Overall, I would say I'm a bearish optimist, right? I think the markets don't have to crash, but the things that we're seeing, definitely you guys should know about. Now, if you guys have not heard, if you did not see the last video, today is actually my birthday. Now, I know some people might not, I guess, understand where I come from when I say this is what I love to do, right? I'm not crazy. I'm just a little nerdy, okay? Instead of going out and partying or any of that, I like to make these videos and talk to you guys and have dialogue between me and you guys, pretty much. The whole reason I started making YouTube videos, if a lot of you guys probably don't remember that video, it's been like a year and a half since I made the video, is because nobody in my real life cares about finance. They don't own stocks, none of that. So if I want to talk about it, I gotta make a video and talk to you guys about it. So that's what I'm very much grateful for, each and every single one of you guys, for this trade with AMC and beyond. I think there is a lot of potential and opportunity for us to profit for years and years to come. So I think that's ultimately very exciting. Now, without too much rambling, let's get into the meat and bones of this video. So like I said, guys, NASDAQ up 17% in the first 3 months of 2023. Now, if you listen to analysts, if you listen to hedge fund managers, money market managers, institutional investors, they're going to tell you it's because there was very low positioning heading into 2023 in technology, which is 100% correct. They're also going to tell you that interest rates falling and the dollar falling has also contributed to this rally, which is also correct. Now, why are interest rates falling? Why is the dollar falling? Those are the things that are really important, because the markets, I'm sure you guys have heard this quote before from Warren Buffett, the markets can remain irrational longer than you can remain solvent, meaning that usually the opposite of what you expect to happen ultimately tends to happen. And the bottom line is, in 2022, when we were actively buying the dip in October and November, not very many people were, and ultimately that's why you've seen this rebound in 2023. But the path ahead does not look so smooth. Now, there's a 60% chance, according to big money, we'll just call them that, hedge funds, money managers, institutional investors, even citizens, that we're going into a recession in 2023. And the real question is, how deep is that recession going to be? And what's the Fed going to do in response to that recession? In other words, where is inflation going to be? Because there's only so much the Fed can do until inflation gets down closer to their 2% target. Now, before we get too far into that, the Fed's balance sheet has also went up about $350 billion, give or take, since this banking crisis has started. And if you overlay a chart of the Fed's balance sheet with the S&P 500, every time the balance sheet increases, stocks also increase. So that's another big reason why the markets are up. I think a lot of it does have to do with trading algorithms, because notice this. The volume on the NASDAQ and the S&P, well, these indexes are going parabolic. The volume is below average in a volatility kind of environment, right? To the upside or the downside. So you're not seeing heavy volume really contributing to this, and that's another reason why I think this is mostly driven by algorithmic trading programs. Now, when the Fed increased their balance sheets, that's bullish. When investors have very low positioning in technology, that usually gives you a bullish rally at some point. Seems like that is taking place in 2023. You're starting to see inflation coming down, and the Fed is almost done with their tightening cycle as long as inflation continues to go down. Those are very bullish things. And let me briefly give you guys the path forward, how this market could continue to rally from here. Number one, earnings hold up. And what I mean by that is earnings don't have to be perfect, but investors, they are expecting a high EPS for the S&P and the NASDAQ. You're expecting a roughly 5% increase to company earnings for 2023, or 5% EPS growth to the S&P 500, I should say, is a better way to put that. And give or take, these estimates fluctuate every day, but it's about 5%, right? Maybe about 4% now. Well, if those earnings even come in at a 3% gain, that's probably going to be a good thing, right? Because a lot of people expect, earnings to be very bad. That's number one. That's going to help get us to that point. But really the bottom line to this is if inflation continues to go down. If inflation does go down to 3.25%, like Fed Williams thinks by the end of 2023. If a recession does come towards the end of 2023, the Fed can start to accommodate a little bit more. We're not going back to COVID era liquidity. That's not going to happen. We're deglobalizing, right? Globalization has led to very low inflation for the past 45, 50 years since the 80s. Think about China producing so many goods for us much cheaper than Americans can, or in Mexico or Brazil or other countries, right? Globalization, making things cheaper, causing inflation to stay low. We're out of that environment. So don't expect massive liquidity from the Fed anytime soon. That's not going to happen. But if you get inflation going down, and the Fed can accommodate the markets and really be able to accommodate the markets because inflation is down and earnings hold up, that's your Goldilocks kind of situation. Now, the bear case here is that earnings fall more than expectations. Inflation does not fall nearly to the degree that some Fed members expect. Fed Williams is expecting inflation to drop by about 50% from current levels by the end of 2023. Those are pretty high expectations. If that does not happen, you have a problem. But ultimately, it does come down to economic activity as well as earnings. All three of these things are really vitally important. Now, in this rally that you have seen specifically in the NASDAQ and the S&P as of recently, it has not been earnings estimates going higher. Believe it or not, NVIDIA, Facebook, Tesla, Apple, they've all seen their EPS numbers come down by about 5% for this upcoming earnings quarter. And that's interesting because earnings expectations going down usually leads to stock prices going down, but that has not happened this time around. Well, it's because of multiple expansion. It's because of the things that we talked about, specifically the Fed increasing its balance sheet. Now, the multiple expansion, the best way to think about this is simple math, right? Very simple math. So the S&P in 2022 returned about $220 of EPS, of earnings per share. Simple as that. Well, you times your EPS by the PE ratio, right? The earnings multiple. And that's what you'll hear. If you hear earnings multiple, it's PE multiple. You times 220 by, call it 18.5. That's kind of where you've been at in a range around 18.5 for the last year and a half. Well, that puts you at 407 on the S&P 500. That literally puts you, give or take, 0.25%, 0.5% from where the S&P currently is. So, okay, makes a little bit of sense, right? Well, if you start to get multiple expansion, you still take that $220 of EPS, but you can times that by, call it 20. And you're at 4,400 on the S&P. So multiples expanding just a little bit can give you, dramatic rallies in the markets. Now, if you take that same 220 EPS on the S&P 500 and you times that by a recessionary EPS, and this is on the high end, historical recessions have been in between 10 and 15 for the PE ratio. If you do the high end of 15, you're at $330 on the S&P 500. So if this bearish case does start to play out, this banking crisis is worse than we expect, and it's really the snowball effect of economic activity slowing down, and you start to get this fear about really a recession over anything else, and the Fed not being able to pivot or U-turn in a way that the markets expect coming, when that recession comes because inflation is too high. That's where you could see some pretty dramatic drops in the markets. And really, I think this upcoming earnings season will be very, very important. And that's because it's the first earnings season of 2023. You're going to have some recalibration of earnings expectations, and that's ultimately what drives the stock market here. And if this banking crisis, believe it or not, does die down and the fears kind of go away, and the Fed's balance sheet drops, well, that is going to fuel a lot of potential pain that we could see in the markets over the short term. Now, some other arbitrage kind of things that I've been looking at that I personally have noticed by just looking at the S&P 500 is that the markets usually go through insane rallies before big crashes actually happen. And you could, there's a lot of places you could read this and look into it. I just simply Google search, do markets usually rally before crashing? It says there could be a stock market rally before a crash. Despite fears of an impending downturn, it's not unusual for a market that will rise sharply in periods of instability. Once a certain price is hit, the market enters into a decline. A fall of 20% is needed from the high before it's considered a crash. And that's the long story short. Usually before these big crashes, you see the markets act irrationally exuberant, and everyone goes back to everything's fine and really disregarding anything else. And that's kind of where you're starting to get at. Again, the NASDAQ rallied 17% in the last 3 months. That's huge. That's really causing a lot of people to get on the other side of the bearishness, right? A lot of people were so bearish heading into 2023. A lot of people were calling for the crash in the first half of 2023. Now you're not hearing a lot of that. Now you're hearing that the markets are probably going to hold up, that earnings are probably going to hold up, and people are really off sides there. And why I think the markets do ultimately rally before a crash is because not everybody can get paid out. And I said this in the last video about a crash that I made, that you can't have everyone expecting a massive crash and it happens, because there's too much insurance, there's too many people expecting it to happen. Now, when you least expect it to happen, typically that's when it tends to happen. And from my perspective here, I could see the markets rallying for the next couple of weeks. Honestly, maybe another month or two. In all reality, it could last longer than that. And then the pain really comes when everyone starts to think things are over. It's likely even if inflation does come down, but the economy does go into a sharp downturn, it's really going to be at that least expected moment. So the higher the markets go from here, the more cautious you really and truly want to be, because this could be a massive opportunity for everyone, or this could, at least for you guys that kind of see things for how it is, or it could be a really bad time to buy the dip. Now, I mean, maybe all things are fine and we go back to new highs. Doesn't look very likely, guys. So those are some of my thoughts. Obviously, there's things we could look at here, like the yield curve inversion. It's not actually the inversion that's the problem. It's when the yield curve starts to uninvert, when those short-term bonds, those 2-year bonds really, or really the 3-month, 6-month, 12-month, 2-year bonds start to fall in yield. That means investors are actually buying bonds, and you typically don't buy bonds when there's going to be a lot of growth in the markets. When the markets are expected to be bullish, typically you don't get a lot of people buying bonds. Also, interestingly enough, gold, Bitcoin, bonds, your safe assets actually rallied in the last 3 months alongside technology, and that's a very rare phenomenon to actually happen in any market environment, but let alone what we've seen over the past couple of years. Typically that does not happen. So a couple things obviously to be watching for. Really, it's going to come down to earnings, in my personal opinion, and why that is really the case is because a lot of this market is just being controlled by the top 10 stocks, really the top 5 stocks, your Apples, Amazons, Googles, Nvidia now, even Tesla, Microsoft, right? Those companies, if they have bad earnings, it's going to be painful for the markets. That is over 30% of the market in those names alone, the top 10 names. So yeah, just some things that I am personally watching. Obviously, the recession is going to be a main focus point as well that I will be monitoring very closely. And really, I don't think that the actual consumer slows down their spending habits or prepares for a recession until you get more recession talk on mainstream media. We've seen a little bit of it every now and again. My mom, trust me, she watches a lot of news. She's starting to talk about a recession. So I think we're getting to more of this general population being aware of a recession and the possibility of one later this year and even into 2024. But I don't think you're there where the average American understands the risk of a recession that we're about to go in. I think that takes some time, and I think you need the news to start talking about it. So the day that things really start to flip and the news starts to talk about it and average people start to talk about a recession, that's when people will actually slow down their spending, and that is when the economy will get much worse. So that's kind of an arbitrage thing that I'm personally looking at in my day-to-day kind of life and routine to see when that inflection point actually happens, because that's when you want to start watching economic data a lot more closely. Now, if we actually take a brief look at the charts for the S&P 500 as well as the NASDAQ, you could see kind of, I'll show you what I mean by the markets rip before they ultimately drop. And you can see it in most cases, right? Back here, 2018, twice in 2018, right? I mean, the markets from December 2017 through January 26th of 2018, guys, it's kind of like so obvious it's ridiculous. The markets rallied 7% in this period of time before the markets ultimately dropped like 15-20%. Well, what happened? You rallied back up, continuous rally. It wasn't as aggressive as this, and then you dropped again, right? You come through here, you typically see a ramp up into a crash, and that's exactly even what you've seen before COVID, right? Very aggressive rally towards the top, and you crash. Same thing even over here, aggressive rally after COVID in June, and you crash a bit, right? Right here, pretty bullish, crash, pretty bullish, crash. Like it's pretty simple to see, right? And even in November, right, it was choppy of 2021, and January, December of 2021, it was choppy, but you ultimately rallied into the high and then came crashing down. You typically tend to get a lot of exuberance and a lot of bullishness before that crash does happen, and the higher we go from here, the more pain we're going to see. Now, I think this next time will be the bigger one, and I think earnings are just not going to be as good as people expect. I think a lot of companies have seen a lot of kind of demand get pulled forward because of COVID, and a lot of people don't need to buy that iPad or that iPhone or get that new Microsoft product, right? Their Xbox or whatever the case is. So, yeah, I'm optimistically bearish. Maybe I'm wrong. I mean, I got a lot of long-term stocks and a decent portfolio, so maybe I am, and hopefully so. But from my perspective here, it's a massive opportunity right around the corner, guys. So hit that like button, subscribe to the channel, source your comments, questions, or concerns down below in the comment section. Thank you guys for watching, and I will see you in the next one.